Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 8 of what is now going to be my 9-part video series on Roth IRA conversions. In this video, we're going to tackle the special topics of IRA Basis, Non-Deductible IRA Contributions, Excess Contributions, Form 8606, and how all of these items impact the taxability of our Roth IRA conversions. So if you're ready for some special IRA topics, let's jump in. And by the way, if you enjoy this video, please like and subscribe and let me know in the comments what's going on in your personal tax planning situation. All right, we're going to start today's video by making sure we understand the difference between a non-deductible IRA contribution versus an excess IRA contribution. Now, an excess IRA contribution occurs if you contribute more than the contribution limit in any given year. This is the main reason for an excess IRA contribution. And you might ask, well, why would somebody contribute more than the contribution limit? And the answer is that usually it doesn't happen on purpose. This commonly occurs when a person has multiple IRAs and they are contributing smaller amounts on a regular basis, which mistakenly accumulate to more than the annual limit. Another thing that could create an excess IRA contribution is if you make a regular contribution for 2019 or earlier. So obviously this is highly unlikely at this point to even be an issue anymore. But you do that to a traditional IRA and you are over the age of 70 and a half. So basically under old law, which has now been changed, you could not make a contribution to an IRA if you were older than 70 and a half. That was the old law. However, we had a law change under Secure 1.0, and the law change is such that for 2020 and later, there is no age limit on making regular contributions to traditional or Roth IRAs. So basically, you can contribute to a traditional IRA at any age now, as long as you have earned income, like W-2 income, or self-employment income, which would be like Schedule C income. But again, this is since 2020 already, so this is really no longer much of an issue. The main issue is usually if you just contribute little by little over the course of the year, and then by mistake it accumulates to more than the annual contribution limit. So an excess contribution has to do with an annual dollar threshold for IRA contributions, and that annual threshold for 2024 is $7,000 or $8,000 if you are over age 50, and this is per spouse. So each spouse can contribute up to $7,000 or $8,000 if any particular spouse is over the age of 50. Now, a non-deductible contribution has to do with whether you can take a tax deduction in the current year for your $7,000 or $8,000 if you're over 50 annual contribution. So let's have a clear distinction between these two things. First, the annual contribution itself. Anyone with earned or self-employment income can put $7,000 into a traditional IRA in 2024. This is regardless of your income level, as long as you have at least $7,000 in earned income. When I say regardless of your income level, what I mean is you're not phased out if you have too much income. And it's regardless of your retirement plan coverage at work. So that's the actual contribution itself, and we want to distinguish that from the ability to deduct the contribution on your tax return for the given year. Your ability to deduct the contribution may have limitations. So the distinction in summary is that anybody with at least $7,000 of earned income can contribute, but there may be limitations on your ability to take a tax deduction for that contribution. Now, if you are not covered by a retirement plan at work, then there is no limitation. You can deduct the $7,000 or whatever the amount is for the given year. That amount can be deducted in full. On the other hand, if you are covered by a retirement plan at work, and this is you and or your spouse, then the deduction may be limited based on your income level. So again, right here under this traditional IRA section at irs.gov, no retirement plan at work, your deduction is allowed in full if you and your spouse, if married, aren't covered by a retirement plan at work. By the way, if you are not sure if you are covered by a retirement plan at work, being covered doesn't necessarily mean you participate in the plan. You could technically be covered by a plan and not actually make contributions. So if you're not sure, where is the first place that you can check? And the answer is on your W-2. Right down here in box 13, which I have a larger version of right here. Here is a box for retirement plan. If this box is checked, you are most likely covered by a retirement plan at work. If you are still not sure, or you think this box is checked or unchecked incorrectly, then you would need to contact your HR and ask. All right, so pop quiz number 1. If you and your spouse were never covered by a retirement plan at work, meaning ever in your lifetimes, which would certainly be the exception rather than the rule. But in that specific case, is it even possible that you could have a non-deductible contribution to a traditional IRA? And the answer is no. The only way you can have a non-deductible contribution in the current year or at any time in the past is if you have retirement plan coverage at work, plus you have an income level that is high enough that it caused a limitation on the deductibility of any IRA contributions. Okay, so if you are covered by a retirement plan at work, then what are the income limitations? And that's going to be based on modified AGI. For now, just assume that modified AGI just means your income. We can get into the specific details later of what adjustments need to be made to AGI in order to arrive at an MAGI, a modified AGI for this purpose. But for simplicity, let's just say this is your income. So using married filing joint as an example, if your income is $123,000 or less, and these are 2024 numbers, a full deduction up to the amount of your contribution limit is allowed. If you are at $143,000 or more, then there is no deduction allowed. You have a total phase out of your ability to deduct any contribution. And then if you are between $123,000 and $143,000, then you have a partial deduction or a partial phase out of your ability to deduct any annual contribution made. Okay, pop quiz number 2. For 2024, you are 55 years old. You are covered by a retirement plan at work. Your MAGI is $150,000. You contribute $9,000 to a traditional IRA. What are the results of this situation? Well, number 1, you have an excess contribution of $1,000 because the contribution limit for someone over 50 years old in 2024 is $8,000. So you need to withdraw that $1,000 plus any related earnings on that $1,000 by the time you file your tax return. That includes extensions, or you will get dinged with penalties. In fact, if we go all the way back up to the top here, we skipped over this section, but now is a good time to cover it. Excess contributions are taxed at 6% per year. For each year, the excess amount remains in the IRA. To avoid the 6% tax on excess contributions, you must withdraw the excess contributions from your IRA by the due date of your individual income tax return, including extensions and any income income earned on the excess contribution. So if you do have an excess contribution, hopefully you will figure that out before you file your tax return, including extensions all the way to October 15th. And as long as you get your broker on the horn and say, hey, take this amount of money plus any related earnings out of the IRA, and you do that before you file, then you can avoid the 6% excise tax. And then if we go back down here to the results of our pop quiz, item number 2, you have a non-deductible contribution of $8,000 because your MAGI is over the limit, so you are fully phased out of any deduction. Now, if you do have a non-deductible contribution to a traditional IRA, just like the situation right up here, then that contribution creates basis in your IRA, and basis is what we're going to talk about next. All right, the next question is, what is basis? And the simple answer is that basis is money that has already been taxed. Let's do some examples. Example number 1, you buy 1,000 shares of XYZ stock for $30,000 in a regular brokerage account. You sell it for $40,000. How do you calculate your gain? Well, a basic gain calculation goes like this. Sales price of $40,000 less basis of $30,000 equals gain of $10,000. In a regular brokerage account, you bought that stock with money that was already taxed. In other words, this $30,000 here is after-tax money. This had already been taxed at some unrelated point in the past before you ever used it to buy the stock. So you don't have to pay tax on that $30,000 again later. You only have to pay tax on the difference between the sales price and the $30,000 of basis. So you are said to have $30,000 of basis in that stock position. And note that sometimes this is called cost or cost basis or just basis. All of those effectively mean the same thing. Okay, example number 2, you buy a house for $500,000 and you add on a new room for a cost of $80,000. You sell the house later for $700,000. How do you calculate your gain? Well, in this situation, we need to figure out what our basis is first before we can calculate our gain. So we're going to do a basis calculation starting with the original cost basis of $500,000. Then we're going to add on an additional cost basis of $80,000 for a total adjusted cost basis of $580,000. So in this case, our gain calculation is sales price of $700,000 less basis of $580,000 equals a gain of $120,000. So again, you bought your house and added on a room using money that was already taxed. You won't be taxed on that money again when you sell the house. You are said to have basis or adjusted basis of $580,000 in your house. Example number 3, you contribute $8,000 to a traditional IRA and don't get a deduction for it. If you don't get a deduction for it, then you have paid tax on it. Therefore, you are said to have basis in your IRA of $8,000. Okay, these two phrases basically mean the same thing. Not deducting something is the same thing as being taxed on it. So if you don't get to deduct it, then you have paid tax on it. Therefore, it is after tax, and therefore you have basis in that amount. All right, pop quiz number 3. Can you ever make a non-deductible contribution to a Roth IRA? And the answer is, of course you can. All contributions to a Roth IRA are non-deductible. Okay, Roth IRA contributions aren't deductible. You can only contribute to a Roth IRA money that has already been taxed. So let's do a basis example with a traditional IRA versus a Roth IRA. Okay, for this example, let's make the following 2 assumptions in order to make the math easy and focus on what basis really means. Assumption 1, the annual contribution limit is going to be $7,000 for all years. Number 2, you are covered by a retirement plan at work for all years. And then finally, the MAGI threshold for traditional IRA full deductibility is going to be $123,000 $133,000, and the total phase out will occur at $143,000 for all years. In other words, we're just going to hold all of these numbers constant across the 5 years in the example. We're not going to adjust them for inflation. Okay, your modified adjusted gross income for this example between 2020 and 2024 is going to be $100,000, $150,000, $170,000, $120,000, and $120,000. You make the following contributions to your IRAs, of which you have a traditional and you also have a Roth. Determine how much basis you have at the end of 2024 in each of these two accounts. Okay, in 2020, you contribute $3,000 of your total $7,000 contribution to a traditional IRA, and you contribute $4,000 of it to a Roth IRA. Question 1, do you have basis in this $3,000? And what is the criteria we have to consider? Well, 1, are we covered by a retirement plan at work? And the answer to that is going to be yes for all of the years based on the fact pattern that we laid out before, so that's covered. The second criteria is modified adjusted gross income. If it is below $123,000, then we know it's fully deductible, any contribution to a traditional IRA. So we know this $3,000 is fully deductible, therefore it's not after tax, therefore it does not create basis. So the answer is no basis in this $3,000. What about over here with the Roth IRA? Do we have basis in this $4,000 right here? Well, we just said Roth IRA contributions are never deductible. They are always after tax. After tax money means you have created basis. So yes, there is $4,000 of basis right here. So this $3,000, no basis. This $4,000, basis. Okay, for the rest of the examples on this side, I'm not going to repeat that we are covered by a retirement plan at work. We always are for all years. So all we're going to think about is our MAGI versus the threshold. So in the second year, is our MAGI of 150 over the top of the threshold for the full phase out of 143,000? And the answer is yes. Therefore, this was not deducted. This is after tax. So yes, this creates basis right here. The Roth IRA side always creates basis. A contribution to a Roth IRA is always after tax, always creates basis. So this time we have basis and basis. How about in year number 3, we have $5,000 here. Our MAGI is 170, that's over the threshold. This $5,000 is basis. This $2,000 is always basis because it's an after-tax contribution to a Roth IRA. In 2023, our MAGI is 120, which is below the threshold. That means this was fully deducted. This is not after tax, this is pre-tax because it was fully deducted. If it's not after tax, then it did not create basis. So this is no basis right here. Roth IRA, always basis. And finally, 2024, we have $120,000, which again is completely below the threshold, so it's fully deductible. That was deducted in full. No tax was paid on it. It is not after tax. Therefore, it is not basis. Over here, always basis. So here is our solution to the traditional IRA. The first year was no basis. Second year, basis, basis, no basis right here in the last year. So what's our total basis in this traditional IRA? $7,000 from these 2 years. What's our total basis in the Roth IRA? Well, it's all of this, which is $21,000. Okay, now let's say we want to do a Roth IRA conversion, and this is our traditional IRA. Note that this is the traditional IRA from the previous example. We have a total basis of $7,000, which was these two right here, and then we have a total account balance of $15,000 for this example. Assume we do a full Roth conversion of the $15,000. That would mean we are taking a $15,000 distribution from a traditional IRA for which we will get a 1099-R. How much of the $15,000 is taxable income? Well, the calculation for that is pretty straightforward. We have the distribution of $15,000 less the basis that we have in the IRA of $7,000 results in taxable income of $8,000. Now, despite the fact that we can calculate the taxable income, let's say we proceed with this transaction and our broker sends us this 1099-R right here. Very common common to see the gross distribution listed right here, the taxable distribution listed as the same amount, and then this box checked that says taxable amount not determined. And the reason that this is the case right here is because the broker often doesn't know how much of the distribution is taxable. So they will commonly just put the same amount that's in box 1 right here in box 2A and then just check this. So you have to know what your basis is in the traditional IRA. If you don't know or haven't been tracking it, you might get taxed on that $7,000 of basis again without even realizing it. So how do you determine what your basis is in the traditional IRA if you haven't been tracking it? And the answer to that is figuring it out will probably require a bit of legwork. And you will have to do a sort of cost-benefit analysis for yourself to determine if the effort of tracking down this information is worth the time and energy that it might take. Not only the time and energy, but the amount of tax savings that you will ultimately receive by not being taxed again on your basis. So if you decide to proceed with tracking down what your basis is, then step 1 would be to look at your traditional IRA brokerage statements from prior years and determine if you have contributions to those traditional IRAs in prior years. If the answer to step 1 is yes, then you have to look at your tax returns from the same years. If you do not see a deduction on your tax returns for the equivalent years, meaning the equivalent years where you found contributions on your old IRA brokerage statements, then those contributions created basis in your traditional IRA. So again, if you do not see a deduction, then they did create basis in your traditional IRA. And they would not create taxable income now when doing Roth IRA conversions or when simply doing distributions of the money in any form, whether it's a Roth IRA conversion or otherwise. So the cost-benefit analysis is going to be, do you have enough of these kinds of contributions that may not have been deducted? And if so, is it worth tracking them down and gathering up the documentation so you can support the fact that they should not be taxable income to you now when doing Roth conversions or simply taking distributions out of that traditional IRA. If you are looking at those old tax returns to see if a deduction was taken for the contribution to your traditional IRAs, the line where you will need to look is going to vary. I grabbed this little helpful index out of TurboTax, where to find IRA deductions on your tax return. Find the line titled IRA deduction in the AGI section of Form 1040 or Schedule 1, and then if it's an earlier year return, going back all the way to 1992 on this list, it tells you what lines you have to look for this item. Because the lines on the tax return change over the years as the IRS updates them, and so going back through all these years, you're going to have to look in different places. You can also check your Form 8606 for your total IRA basis, but this is only true if you've actually been reporting your contributions on your tax return going back as far as the times that you were making them, going back through all these years if those are applicable to you. We're going to go through a Form 8606 in some detail coming up shortly, and I will show you on what line you can look for this item. Now, if you don't think that you had a lot of non-deductible contributions to traditional IRAs, or by the way, this can even be like after-tax contributions to an employer plan, typically that would be like a 401k, that was later rolled into a traditional IRA when you left that employer. Okay, if you had after-tax contributions, i.e. not deductible contributions going into that 401k, and then it got rolled into the IRA, those still carry forward into the traditional IRA after tax, and when they get converted to Roth or just get distributed from the IRA, they would not be taxable. But again, again, you have to decide. If you don't think you had a lot of that, then it may not be worth your time to try to track it down if you're not tracking it already. And if that's the case, you may just have to accept the possibility that you're getting double taxed on some portion of those traditional IRA distributions, again, whether it's via Roth conversions or just regular distributions out of an IRA. Now, as it mentioned above, if you've been filing Form 8606 with your tax return, in other words, check your prior year return to see if it's in there, the amount you need should be on this form, assuming you've been entering the information in prior years, like I mentioned. It's going to be on line 14 of the 8606 for any particular year. So for example, this would be your IRA basis at the end of 2023 going into 2024 right here on this line 14. If you went to the 2022 version of this form, this would say your total basis in traditional IRAs for 2022 and earlier years. So that would be your December 31st, 2022 number carrying forward into 2023. Now let's go to our taxable versus non-taxable Form 8606 calculations. All right, so if we're going to do a Roth conversion when we have basis in our traditional IRAs, here is the information we will need to gather. Note that you can skip any items that are not applicable to you in the current year. So the first one is basis. We need to know the basis in all traditional IRAs as of 12/31 of the prior year. PY will mean prior year from here on out. Again, we just talked in detail about where you go to track down this information. The second item is contributions. We need to know traditional IRA contributions made in the current year. CY will mean current year from here on out. The third item is fair market value. We need to know the fair market value of all of our traditional IRAs as of 12/31 of the current year. And the fourth item is going to be distributions. We need to know the amount of our regular distributions in the current year, the amount of our Roth IRA conversions in the current year, the amount of our QCDs, qualified charitable distributions, in the current year. This applies to folks who are over 70 and a half and making QCDs. And finally, the amount of HSA rollovers in the current year. Note that this is allowed once during your lifetime. Now, some, but often not all, of this information should be provided to you on Form 5498, which you will receive from your broker. Here is what Form 5498 typically looks like. There's kind of two versions. Up here is what I call the simplified version, which in my experience is the most common one to see. This is just an example that I pulled off the internet. What we're looking for here is the fair market value of the account. Now, occasionally, but not very often, you will receive this full version of the Form 5498. And if you do, then the fair market value of the account is going to be right here in box 5. The most common use of this Form 5498 is simply to get the fair market value of the account at year end. By the way, if you've ever received this form from your broker and you've never done anything with it for your tax return and you've always wondered what in the world is this form even for, the answer is that if you don't have any non-deductible IRA contributions in the current year or in any year, then figuring out these 8606 calculations isn't going to be necessary anyway. This only relates to if you have non-deductible traditional IRA contributions. And so in that case, there's nothing to do with this form. You just put it with your records. Okay, now once we have the basis and fair market value information for our traditional IRAs gathered up, what is the information used for? Well, the answer is it's used to determine the portion of our annual IRA distributions, whether they are regular distributions or Roth IRA conversions, which is taxable versus the portion that is not taxable. So here is the basic calculation. Step number 1, we take the IRA basis for all of our traditional IRAs combined, and we divide it by the fair market value of all of our traditional IRAs combined. And we multiply that answer by whatever the distributions from our traditional IRAs are for the current year, the grand total. And whatever number that comes up with, that is the non-taxable portion of the distribution for the year. Step number 2 is we take the total distributions for the current year, we subtract off the non-taxable portion of the distribution that was just determined in step 1, and that will give us the taxable portion of the distribution for the year. So let's do an example using this fact pattern right here. We have IRA basis of $30,000. We have IRA fair market value of $800,000. We have total IRA distribution for the year of $50,000. So the taxable versus non-taxable IRA distribution basic calculation will be as follows. Step number 1, IRA basis of $30,000 divided by IRA fair market value of $800,000 gives us the percentage which is non-taxable, which in this case is 3.8%. Then we take the total distribution, which was $50,000, we multiply it by the 3.8%, and we get the non-taxable portion of the distribution, which is $1,875. Then step number 2, we take the total distribution of $50,000, and from that we subtract the non-taxable portion determined in step 1 of $1,875, resulting in the taxable portion of the distribution of $48,125. Now let's do the same example with a slight adjustment. We're doing taxable versus non-taxable IRA distribution with a Roth conversion allocation, meaning we also did a Roth conversion as opposed to just a regular distribution. In the previous example, the $50,000 was just a regular distribution, not a Roth conversion. Okay, so now the fact pattern is the same IRA basis of $30,000, the same IRA fair market value of $800,000. The total distribution for the year is still $50,000, of which $20,000 is going to be a Roth IRA conversion, and only $30,000 if it was a regular distribution or an RMD. Note that you can't do a Roth conversion with the amount that relates to an RMD. So in this example, we can assume that the $30,000 was an RMD and the $20,000 was just an additional amount that you chose to do a Roth conversion with. So in this example, step 1 is going to be the same. We take the IRA basis divided by the IRA fair market value to get the percentage that is non-taxable. We multiply that by the total distribution and we get the same non-taxable portion of $1,875. But now in step number 2, we have to allocate our non-taxable portion between the regular part of our IRA distribution and the Roth conversion part of our IRA distribution. So in this case, we had a regular distribution or an RMD of $30,000 and we did a Roth conversion of $20,000. That's our total $50,000. So right here in this cell, I'm going to take $30,000 and I'm going to divide it by the sum of these two, or $50,000, and I'm going to get 60% allocation to our regular or RMD distribution. The other 40% is going to go to our Roth IRA conversion portion of the distribution. So here's the non-taxable portion in total, $1,875. I've put that in both columns. In this column, I've multiplied the $1,875 by the 60% to get $1,125 allocated to the regular portion of our distribution. And over here we have $750 allocated to the Roth conversion portion of our distribution. Then right down here, the taxable part of the allocation is going to be the $30,000 total distribution minus the $1,125 non-taxable portion allocated to the RMD or regular distribution, leaving a taxable portion of $28,875. Over here is going to be the same thing. We're going to take the $20,000 total distribution. We're going to subtract off the $750 non-taxable portion allocated to the Roth conversion, leaving a taxable amount of $19,250. And the reason we want to understand how these numbers here are calculated is for purposes of the Form 8606. Right here on line 11, it says this is the non-taxable portion portion of the amount you converted to a Roth, which in our example would be this $750. And then on line 12, this is the non-taxable portion of your distributions that you did not convert to a Roth, which in our case would be this $1,125. All right, now that we've completed an IRA distribution of which some portion was a non-taxable return of basis. By the way, these phrases right here mean the same thing: non-taxable traditional IRA distribution and return of basis. In other words, the entire reason why some portion of the traditional IRA distribution is non-taxable is because it is basis being returned to you. Okay, so right here in this picture, this is our non-taxable traditional IRA distribution or return of basis in the previous example, this $1,875. So let's do a pop quiz. If our beginning IRA basis, let's say January 1st, 2023, was $30,000 right here, and $1,875 of our basis was returned to us as part of the 2023 IRA distribution, how much traditional IRA basis do we have left at 12/31/2023 based only on the fact pattern that we've laid out so far? And the answer is as follows. Let's do a simple basis reconciliation. The January 1st, 2023 basis was $30,000. We had a return of basis of $1,875. Therefore, our December 31st, 2023 basis would be $28,125. And that is the number I would expect to see on this line for this example. Your total basis in traditional IRAs for 2023 and earlier years would be this number, $28,125, and this is what would carry into 2024. And what are we going to see on the first page of the 1040 in this fact pattern? Well, right here from step 2, total distribution of $50,000, we had a non-taxable portion of $1,875, leaving a taxable portion of $48,125. So I would expect to see line 4A IRA distributions with $50,000 on it, and line 4B the taxable amount with $48,125. And this right here is one very common reason why you might see a difference between these two lines. All right, now that we've covered the basics, it's time to take things to the next level with an all-new 3-part video series where we will cover the following topics. We're going to build out a full IRS Pub 590B Worksheet 1-1 calculation in Excel for purposes of determining our taxable versus non-taxable IRA distributions. We're going to walk through the entire calculation, including regular distributions, Roth conversions, QCDs, HSA rollovers, and Box 1 of 1099-R tie-outs. We're going to figure out our taxable distribution related to the Roth IRA conversion portion. We're going to figure out our taxable distribution related to the amount excluding the Roth IRA conversion portion. We're going to tie everything out to TurboTax entry for Form 8606. We're going to cover number 1, regular distributions with IRA basis for both single and married filing joint. Number 2, regular distributions plus Roth conversion with IRA basis. Number 3, conversion with IRA basis when you're over 70 and a half, making QCDs. Conversion with IRA basis and the one-time HSA rollover from an IRA. We're going to do full IRA Excel-based basis calculations plus taxable to non-taxable income reconciliations. We're going to do the IRS Publication 590 Worksheet 1-1 as I just mentioned above. We're going to do the Form 8606 calcs and the preparation with TurboTax entry as I also just mentioned above. And we're going to do some member Q&A related to the Roth Conversion Tax Strategy tab calculations. That new 3-part update is included with your purchase of the personal tax planning template that you've seen me demonstrate throughout this entire Roth IRA conversion video series. Your purchase helps out the channel and provides you with a tax planning and analysis toolset that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. work. So it's a win-win for everybody. If you are interested in that, there is a purchase link for the personal tax planning template in the description below this video on YouTube. And that's going to be it for part 8 of this video series. I hope you enjoyed today's video. Thanks for watching, and I'll see you in part 9.